Hello. Welcome to Cash Stash TV, your trusted channel for all things finance and entrepreneurship. Do you know what the future holds for banks and financial institutions over the next 15 years? If you're curious to learn more, let's dive in. In the 21st century, banks remain a key part of the global economic machinery. From their origins in the Middle Ages to the current digital age, they have evolved significantly, adapting to the changing needs of societies. In this article, we will delve into the most important aspects related to banks, their advantages and disadvantages for users, how they have changed over time, what products and services they offer, and where their future is headed. Advantages of being a bank client. Banks offer multiple benefits to both individuals and businesses, playing a crucial role in financial well-being. Some of the most notable advantages are: security of deposits. Money deposited in a bank is protected by security mechanisms, including state insurance such as the FDIC in the United States or the Deposit Guarantee Fund in many countries. These protect savings in the event of the institution's bankruptcy. Banks around the world are implementing advanced cybersecurity systems to prevent fraud and digital theft. Ease of access to financial services. Banks offer a variety of services to manage money, from current accounts for everyday payments to savings accounts with competitive interest rates. In addition, online and mobile access has revolutionized the way we manage our finances, allowing transfers, balance inquiries, and payments to be made in a matter of seconds. Access to credit and financing. One of the most important functions of banks is to provide loans and lines of credit, allowing people to finance personal projects such as purchasing a home or car, or businesses to expand their operations. These financial products typically have lower interest rates than other forms of unregulated credit. Generating interest and accumulating wealth. Banks allow their clients to generate returns through instruments such as savings accounts, certificates of deposit, CDS, or mutual funds, helping people grow financially. In addition, many offer more sophisticated investment products, including wealth management for clients with high levels of capital. Stability in financial transactions. Banks ensure that payments and money transfers are made safely and quickly, providing a level of trust that other forms of transactions may not offer. Disadvantages of being a bank client. Despite their advantages, banks also present certain limitations and risks that customers should consider. Fees and commissions. Many banks charge fees for a variety of services, such as account maintenance, withdrawals from other banks' ATMs, and international transfers. These fees can add up, eating into long-term savings. In addition, financial products with variable interest rates can generate unexpected costs, especially in times of economic crisis. Bureaucracy and slow processes. Although digitalisation has improved many aspects of the banking system, there are still bureaucratic processes that can be frustrating for customers, especially when obtaining loans or opening accounts. Documentation requirements can be extensive, and turnaround times for certain transactions can be slow. Lack of customization. Despite the adoption of advanced technologies, traditional banks often offer standardized solutions that do not always adapt to the specific needs of each client. This is especially true for small business owners, who often face difficulties in accessing adequate financing or personalized financial advice. Vulnerability in times of crisis. Although banks are regulated to ensure their stability, they are not immune to global economic crises. Bank collapses, such as those that occurred in 2008, can put customers' deposits and investments at risk. Additionally, sharp changes in interest rates can negatively impact loan and mortgage payments. Technological risks. With increasing digitalisation, banks also face challenges related to cybersecurity. Attacks on financial institutions are becoming more sophisticated, potentially compromising customers' personal and financial information. How have banks changed? Banks have undergone a profound transformation in recent decades due to factors such as globalization, digitalization, and increasing competition from fintech companies. Below are some of the main changes. Digitalization and automation. In the past, all banking transactions had to be done in person, but today, most services can be carried out remotely. Banks have developed mobile applications and online platforms that allow customers to manage their accounts, pay bills, transfer money, and apply for loans without leaving home. ATMs have evolved, allowing for deposits and other more complex operations. Diversification of services. While traditional banks focused primarily on deposits and loans, today they offer a wide range of products, including investment advice, insurance, retirement plans, and even cryptocurrency-based financial products. This has allowed banks to expand their revenue streams and attract a wider variety of customers. Regulation and control. Governments and international organizations have imposed greater regulation on banks following the financial crises, which has forced institutions to be more transparent and conservative in their practices. However, this additional control has also increased bureaucracy and complexity in many processes. Online banks and neobanks. Traditional banks are now competing with so-called neobanks, which operate exclusively online and offer services at significantly lower costs. These institutions do not require physical branches, allowing them to operate on lower margins and attract young, technologically savvy customers. Bank products and services. Banks offer a wide range of financial products and services that can be tailored to different customer needs. Some of the most common ones include current accounts, allow daily management of money, with access to debit cards, checks, and transfers. Savings accounts, they offer interest on deposits for those looking to save in the medium or long term. Personal and business loans, from loans for the purchase of consumer goods, such as cars, to commercial loans for companies looking to expand. Mortgages, financing for the purchase of homes, generally long-term and with fixed or variable interest rates. Credit cards, they provide access to lines of credit with the possibility of paying in installments or at the end of the month. Investments and wealth management, investment advice and products, such as mutual funds, stocks, bonds, and derivatives. Insurance, banks also offer life, health, home, and car insurance, linked to their financial products. The future of banks. Banks have been and will continue to be fundamental in the economic life of citizens, providing security and accessibility to financial resources. However, the banking landscape is changing rapidly. With the entry of fintech players, growing adoption of blockchain and cryptocurrencies, and consumer expectations for more personalized services, banks will need to adapt to remain relevant. The future of banks will likely be marked by the integration of new technologies such as artificial intelligence, which will allow for deeper personalization of services and greater operational efficiency. However, with increased reliance on technology, new challenges will also arise, such as data protection and cybersecurity. For citizens, it is crucial to understand how these changes affect both their personal finances and the economies in which they participate, and to choose institutions that best adapt to their financial needs in this new environment. Thanks for watching Cash Stash TV. If you found this content helpful, give it a thumbs up and don't forget to subscribe for more. Hit the bell icon so you never miss an update. See you in the next video. Cheers!